I think we are live. Hello, hello, hello. Good evening, good evening. Welcome to StockAdda with Janak. Dhankibaat, Saturday evening live stream. So, first of all, before we begin, there are few people joining. Fatafat, give me a confirmation if I'm visible and I'm audible properly. Don't want to go wrong. So, let me see who all are there. Chalo, I think King Tanishk is here. Vansh is here. Big shout out, Tanish. Welcome. Vansh, welcome. I think I'm clearly audible. So, chalo. So, we have a very exciting lineup today. And recently, a lot of there is a significant element of bull market that you're seeing. Market has run up a lot. So, it happens that I got a lot of queries around. Janak bhai, there are so many stocks. Okay, while we talk about so many stocks and so many themes randomly, people wanted a session on is there some science behind identifying stocks beyond basic screeners? So if you put 2 3 checks, you will get a good amount of stocks. But there are still 5,000 stocks, and zeroing on one, two, or maybe 3 to 5 stocks, it is a difficult task. While from the kitty of 5,000, you might be able to eliminate and have 50 60 stocks. But going beyond that is something that you are going to learn today. Okay, and we have with us a very special guest. So just let me share the screen first. And give a small introduction about the speaker today. So today we have with us Kumar Saurabh, who is founder of Scientific Investing, where by nature he is a teacher, okay, into the fields of fundamentals, technicals. But along with it, something that is really special and stands out about Saurabh is his mastery and command over quants and algorithmic trading. Okay, he has been a visiting faculty in various esteemed institutes like IIT Jodhpur, V School, Praxis. He has 15 years of work experience across the areas of analytics consulting, data science, financial due diligence. He has been recognized at top 40 under 40 data scientists practitioners with MLDS by Analytics India magazine. Okay, he has worked with technology and consulting companies like ENY, DXC, VMware, HP, ICRA, TCS. Currently, he is an active investor and a researcher with more than a decade of experience into equity markets. And finally, he has robust social media presence. So you'll find his Twitter handle where he has more than 50,000 of following. He has his own active YouTube channel where he's a content creator by the name of Scientific Investing. So go ahead and check out that channel. And obviously, he has presence on multiple national forums. Having said that, now let me invite Saurabh to our forum. Saurabh, most welcome and thank you for taking out time today. Very happy to have you here.
Thanks a lot.
So, as set the context, okay, a lot of our audience they had requested about Janak bhai. Can you get some guest speaker about how do we go in about zeroing the stocks? 50 100 50 100 stocks to mil jate hain, but what beyond that? So maybe Saurabh bhai, if you can share some experience, and now the forum is yours.
Sure. So thanks, Janak. Thanks first for the warm introduction, and thanks to all the guests who are listening this evening on a weekend. So you raised a very good point that there are 5,000 plus stocks and how to pick stocks, and basically it's a principle of exclusion, not inclusion, because ultimately portfolio mein kya chahiye? We need 20-25 companies. So 5,000 companies, and we need to pick 25 companies, which is not even 1%. So how are we excluding is going to be more important than how do we include. And that is where what I do is I follow a stage level analysis, where at every stage companies starts getting excluded, and then what we are left with, that becomes the hunting ground where some detailed research is required. And if we see what creates money, it's there is no rocket science in that. Basically 3 4 things are required. First we need, and I am talking more from fundamental investing perspective. So again, there are different ways of making money. There is a trading way of making money which depends more on the demand supply of the trading of the stocks, which you see in
Mm-hmm.
technical charts. And then there is a fundamental way of making money where you try to identify good companies with good runway, with good promoters, and then you tag with them, and then over a period of time you make money. So trading is more short term in nature, investing is more long term in nature. What we will discuss is more investing oriented. Maybe sometime else we'll talk about trading also. So basically, if you look from investing, what has created wealth? Like everybody knows HDFC Bank, everybody knows Asian Paints and all. But what is common in all these wealth creation companies? There are three, four things. First, they need to grow. So there has to be a growth runway. If HDFC Bank could not have done that 20% every quarter, it would have not got, where it is today. So growth is very, very important, and growth of not past but growth of the future, because what we are paying to buy a stock, that is for the future. Second, how it will grow. So to grow, you need capital, and that capital has to come from business. So that is why many companies which try to grow very fast, many they just collapse in between. So then, if you are running a race and you try to run too hard, you will fall down. And somebody who is running consistently, he keeps on, going. So companies who can grow on the basis of balance sheet and cash flow strength, they are the companies who grow sustainable manner. And that is why many times you can see there are companies like recently, if we can take example, Future Group company. They tried to grow very fast, but that growth come from debt. That growth didn't come from the real cash profit which the company was generating. So second is to check whether the growth is coming from the internal cash flows of the company, or the growth is coming from outside. And then the third thing is how clean the company and the promoter is. And when all three things are there, then you look at the valuation so that you don't overpay. So basically, all the analysis is about only these three, four things. And once this falls into place, then you take your bet. So whatever stage analysis, whatever exclusion, whatever we do, all is about managing these three, four things from a future perspective.
Got it. So basically, you're saying you'll start with 5,000 companies, have certain checks and balances on certain financial parameters, reduce that pool, okay, and then beyond that, you look at what are the growth triggers and how does the company have the necessary resources in terms of capital, okay. And I do not. So basically, we are not saying that debt is good or bad, but does company have the capability to service that debt and use that capital to grow, along with combining with management efficiency and governance. So Saurabh bhai, can you explain, can we go step by step, and can you take us through each step with example?
Sure. So there are two, three ways you will get a company. One, you will get, maybe you hear from your friends, or you hear from social media, or you came to know about a company you saw on TV. That is the typical way we get. Or the second way is, we all have some of our screeners, and you will run those screeners. So let me take an example. Like right now, I am studying automotive sector. I have been studying from last 6 months. So when you study a sector, you try to see which are the companies which are doing good. So I got an idea of a company, but if I would have run a screener that, let's say, again, I said the company should have growth, the company should have decent return on capital, it should not be very heavy on debt, it should be generating some cash profit. So if you put a simple rule that last 5 years, 10% sales growth, 10% profit growth, return on capital employed average of 5 years should be more than 12%, bare minimum. Instead of debt equity, I look at something like EBITDA to interest. So EBITDA to interest says, jitna bhi operating profit is coming, if company is generating 100 crore of operating profit, and he has to pay only 20 crore of interest, which means company can pay almost 5 years of interest. But imagine if company is having operating profit of 100 crore and interest is 90 crore. It's a very serious situation. So maybe three times above EBITDA to interest. And cash flow, some cash flow EBITDA. I look at EBITDA, how much of EBITDA is converting into cash flows from operation. At least 70% should be there. So that is the first stage. And when you do, you will get almost 200 to 50 companies. So basically, we have come down from 4,000, 5,000 companies to 200 companies. Now comes little bit of analysis, because to seriously do an analysis over a company and build conviction, one needs to go through annual reports, conference call, transcripts, which means reading 500 pages. You cannot read 500 pages for 250 companies. So again, exclusion. So first level of exclusion is done. If it is coming from some friend, anyway you have trust, okay, ye banda mera friend hai, kuch to acha hi batayega, or you go through screener. So that is the first stage. Now you you are in the second stage where you have potentially 200 companies. So how do you do it? So what I do is I look for the history, because if the history is good, the chances of future is also good. So companies are like, human beings, because companies are run by human beings. Somebody who is, who is a big, bevda, all of a sudden you won't find ki next day he will become a saint. He will still remain that. Maybe out of 101 people, they convert. So companies are also run by people, and the culture doesn't change. It change, maybe structural changes, they happen rarely. So that's a history is a reflection of how well the company has been run, how well the promoter has been running it. Is the promoter a very good capital allocator? Does the promoter respects a good balance sheet? Is the promoter aggressive enough to grow? And if he has done in past, chances are there that he may be able to do, but of course we need to do a future study. So we do a very good historical analysis of the numbers, and financial numbers are a reflection of what the management has done. So let me just share my screen and show you how I do it. So let me share my screen. So because I am studying auto sector, I will take a auto company just to show all the examples. So this company is steel strip wheels, and it's not a company which I had tracked from a long time. This company came on radar because it came in one of my screeners, and I liked the numbers, and I was studying, this sector. So if you see, what we have done here is we have all the numbers: sales, EBITDA, profit before tax, profit after tax,
सौरभ भाई
EPS.
थोड़ा zoom in कर दो. The
Sure.
font is, yeah,
Let
too
me know if
small.
is this visible now?
Yeah, let me ask the audience if the font is visible. Okay. The rest, it seems fine to me. Yeah, you can go on.
Okay. So
Yeah.
basically, you try to evaluate company on P&L, on balance sheet, and cash flows, and then
Hmm.
8-year history, 5-year history, 3-year history, 1-year history. Now see this company, and again, whatever we are discussing, nothing is a stock advice. I am currently holding little bit, but take it more as a framework and the exercise. So if you see this company, 8-year sales CAGR 16%, 5-year sales CAGR 22%, 3-year 20%, and
Hmm.
auto sector, it has gone through one of the worst periods in last 3 years, and despite of that, if this company has grown at 20%, that is something good. Same way, if you see, okay, sales to grow, but is the company generating profit? So even profit number is good. Profit is also okay, but profit is an accounting concept. In PNL is an accounting concept. Real cash profit is the company generating. If you see,
Hmm.
against 16% sales growth, 15% cash flow, against 22% sales growth, 13%, against 20%, 32%. So decent cash flow generation. And this has come without any major debt. In fact, the company has kept on reducing debt. The company has kept on reducing working capital cycle. And that is why the company has generated good return for investors. So 10-year market cap has grown at a CAGR of 36%. 5-year market cap has grown at a CAGR of 15%. So this looks like growth wise the company is good. Now let me see if
Hmm.
the balance sheet is good. So balance sheet is good. You check by debt equity ratio. So here I have the interest coverage. So 5 times, which looks pretty decent. Then let me check if the cash flow conversion is happening or not. So the company is converting the cash flows really well. You see the PAT is getting converted into cash flow. On a PAT of 592 crore in 8 years, the company has generated almost 1,500 crore of cash flow. So everything looks decent, even free cash flow. So the company is doing capex, and after capex, still it has generated decent amount of free cash flow. So I'll not go into detail, but you have parameters to judge
Got
growth,
it.
you have parameters to judge balance sheet, you have parameters to judge cash flow, you have parameters to judge if the business is sustainable or not. So you can look at the return on capital,
Hmm.
return on equity. Even if you look at those numbers, all those numbers are looking good: 24% return on capital, 28% return on equity. So you look at all of this, and then if you feel you are comfortable, then you try to go to next stage. Or the other way also it helps is, it helps you to identify the right questions which you
Hmm.
should try to find when you are doing a detailed deep dive. Like if I can take an example, here we have something called a net fixed asset turns. Basically, what does it mean is, let's say you are running a restaurant and you are holding, assets like your table, dining table, and all of that, or chairs, or cooking equipment. Let's say you have 100 crore of asset, and annually on that you are generating 400 crore of revenue. So basically, you are churning your asset into revenue 4 times. So your net fixed
Got
asset
it.
turns becomes 4, and higher it is, more good for your business. So if you look for this company, the maximum times it churned its assets, it was 2.6, and the current
Hmm.
working value is also 2.6, but the historical average is 1.7, which is a big number. So is it like currently the company is at its full best
Peak.
capacity and it nothing can improve, or there is a scope of improvement? So that is how you should look at these numbers and think about those questions and then try to see the answer either through the con call or through the annual report. So if a company looks good on
Got
all
it.
these parameters, more or less, then I'm fine. Okay, this company has passed my stage one. Let's go to stage two. There could be a company.
Hmm.
Let me take a company which is a peer of this, and let me highlight. If you look at this company number two, and let me
Mm-hmm.
just come here. So I'll just go to screener, and there is a company called Wheels India. So Wheels India and Steel Strip
Mm-hmm.
Wheels, they are competitors. Just give me 1 second. And if you'll see the numbers of this company, you yourself will realize the numbers don't look as good as Steel Strip will. So if we start comparing this company, and I will take the same sheet. Now,
Mm-hmm.
if you see steel strip will, you saw the growth, and here you see the growth. It's in single digit. If you see the PAT growth, just 2% in 3 years. If you see the cash flow growth, it has not happened. If you see the interest coverage, it's lower than steel strip wheels. So now you get a picture that how I am able to compare, these two companies. And I have shown you only one sheet, but there is a lot to the analysis. We analyze the margin, how things are improving, how things are deteriorating. Is the employee cost rising or is the raw material cost rising? So there are a lot of sheets. I don't want to bombard with
Hmm.
information, but only to judge those four things, all this effort is there from a time perspective, from a metric perspective. And once we get a comfort, then we say, okay, it has passed my this stage. Let's go to the next stage. So that is how we try to do.
Mm-hmm. So basically, what I understand from this whole conversation is, first we need to have certain basics in place, which we can take help of any tool like Screener, Tijori, any other tools, where we see essentially 4 or 5 key areas of the business, friends. So what Saurabh is trying to say here is, okay, is the growth, historic growth in place or no? Is that growth clean or no? Which we get to see in terms of the cash flows. Okay, cash flow and free cash flow, basically whatever pat you are generating, you are actually getting cash or no, or is it stuck in the business somewhere? Okay, and then you look at certain operational ratios, then you look at profitability ratios. Most of the companies have certain element of debt to it. Are you able to service it or no? Post that, the entire universe reduces significantly, and in fact he has taken up one level ahead and compared two competitors. So many a times it happens that we are in an industry where certain parameters may seem good, but there might be certain peer who might be better than that also. We might be missing out on it. So that is something that is a critical learning here, or might be inferior to the same. So we have to see कि आपका भाई बगल वाला कैसे perform कर रहा है. Maybe the industry does not have debt only, and then when you are comparing debt to equity of TCS, Infosys, it might make little sense. But seeing the attrition rate, seeing the cash flow generation capabilities, free cash flows, might make more sense here. Okay, but Saurabh ji, now even if you say you shortlist and come down to say 10, 15 companies, now, so what I understand, our winning ratios will increase drastically here. Okay, 70, 80, but there is still minor, that 1% chance that we might get some false positives. How do we crush that too?
Yeah, so I'll come back to that competitor analysis point because what I showed now, that's a very small part of it. I do a lot of detailed work. And again, there is a tool I have built over a screener for that.
Hmm.
Because again, it's a principle of exclusion because we picked one sector auto and there are 70, 80 subsector. Even if you pick one company, you will get into almost 80 sectors. And many times if we take IT, people will like Infosys lena hai, TCS lena hai, Wipro lena hai, HCL lena hai. So there are multiple options, and how do you decide whether Infosys better or TCS is better? In auto,
Hmm.
I'm doing this study, and there are 140 plus companies, and then auto itself
Correct.
is a big industry. You have two-wheeler, you have four-wheeler, you have commercial vehicle, then you have specialized companies, ancillary. So how do you do it? So we need to spend little more time on the competition analysis. So let me share another tool again which I have built, which I you see the idea is the time is limited and the space is big. So how do you
Hmm.
make the best use of time in the big space so that you get the things right? So again, the idea is to compare those 4 5 good companies in a sector and then see which is better one, so that you focus your energy on the best company. So I showed you this
Hmm.
company steel strip wheel. So like in this tool, what we can do is, that is what I have created it. You can compare any five companies, and all everything is attached to screener. That is how I have built it. And then all the metric which you saw in the single company Excel, now I'm bringing from all those five companies here in this single sheet. So let's say we want to do a growth analysis of these five companies, and this is a 8-year view. Let me again zoom it for everybody's benefit. I hope this is visible.
Clearly visible.
Oh, so this is 8-year view, 5-year view, and down here 3-year view. You have these five companies, Steel Strip and Wheels. They are direct competitors, but I have taken other companies because this company now, all of them, they work somewhere in the tire. Somebody is providing rims, somebody is providing alloy wheel, somebody is providing bead wire, somebody is providing rubber chemical for tire, and Minda is more like a benchmark company I have taken. So they are
Hmm.
semi-related company. All these companies do something around the tire, and Minda is one exclusion, which is more as this is like my go-to company in auto. Like if I have in my portfolio, so are these four companies capable of replacing Minda? That is how I'll take it. Now, if you
Hmm.
simply look at growth, it's very evident there are three companies which are standing out. Steel Strip 16%, Rajratan 15%, NoSil 13%. If you take
Hmm.
5-year view also, Steel Strip 22, Rajratan 26, NoSil 16. 3-year also. So it's not like it's a fluke, they have done it one time. 3-year, 5-year,
Hmm.
8-year, only these three companies
Hmm.
are beating. But when you see
Hmm.
at a profitability level, let's say we start at a PAT level, kuch numbers, there could be some numbers issue with screener you will not get, you need to fix manually. So this is no effort, it's all, just drop and 5 minutes everything is ready. So a little bit of manual effort you will have to do, we need to do. But again, you can see these companies stand out on profitability: 37%, 82%, 22%, 29, 43. Rajratan, the reason could be maybe some of the numbers the company might have a history of less than 8 years. That is why, it might be possible. IPO came maybe later on.
Hmm.
So when you look at profitability also, these companies stand on a 3-year basis. NoSil is not standing out. NoSil is
Hmm.
slowing down. But Steel Strip and Rajratan, they still stood out even on a 3-year basis when auto went through worst of its cycle. So growth is one parameter. So likewise, when you go right, you have margin on a PAT margin basis. So again, you can see Steel Strip wheel, it has, maintained consistency. Rajratan has improved. So 8 years back, 8-year average margin is 7%, 5-year average margin
Hmm.
is 8%, 3-year average margin is 10%, which says ki improvement ho raha hai. It's improving every passing year. So same way again, we go multiple parameters are there, operations, working capital, receivable days, all of that, just to, and then you get a sense. Like if you see in terms of leverage, total debt. See, Steel Strip, it is improving from 1.4 average debt equity. Now it's down to 1.1. But look at Rajratan, 8-year debt equity average is 1.1. 5-year it comes down average to 0.7, and now to 0.6. And NoSil is something which has remained debt free. So it helps you to compare all 4 5 companies on growth, on balance sheet, on cash flow, on multiple things, and then again you get a picture ki okay, this company looks good or this company looks bad, or this company might be better on certain parameters, lagging on certain parameter. Like if I can take one example to show you, I told you Wheels India and Steel Strip, they are very very similar companies. But when you look at Steel Strip Wheels, its fixed asset turnover is much lesser than Wheels India, and still it is doing much better numbers in terms of return on capital. Now, as a researcher, you have to think why Wheels is able to generate much higher revenue on its asset compared to Steel Strip, and despite of that, why it is underperforming. So this becomes a
Hmm.
question which I will try to seek
Hmm.
answer when I'm trying to study Steel Strip Wheels in detail. So it also helps me to ask the right question which I am going to explore, and that itself will give you a very big business insight when you go and try to identify the answer. Sometimes the modes or the barrier to entries or the business answers you are able to get because you pick the right question through all this analysis. So this is the typical stage 2 analysis. So even if like there are 5 companies coming in this sector, maybe I will find 2 best companies and again 3 will drop off.
Hmm. Got it. Got it. So now, Saurabh, my question over here is: you raised a very valid point, and it really got my fancy and attention. That one company who is performing better, yet it is not commanding premium multiples. Okay, so can you help me dissect? Okay, how, what exactly do you see in the business, or rather, where to look? Because even in business, there are so many things. Your suppliers, your modes, the management history is there. So, what goes into this, and how do you, where do you start looking for it, basically?
Yeah. So first level, this analysis itself will help because those four things. If the company is not getting a good valuation, it comes only because of four, five things. Either the growth is choked, or
Hmm.
historic growth might be good, but the future growth is questionable. So, like if I can take again
Hmm.
exam from Auto, Amar Raja battery. You see what kind of
Hmm.
valuation it got in 2016. 30 40
Hmm.
PE, and the stock has not done
Hmm.
well. It has come down from maybe 1500 rupee to 500 rupee. Why? Because maybe slowly the market realized that this battery is going to be history and the future is about different kind of batteries. The company couldn't get into this new wave, and that is why sometimes value investing remains very harmful, because
Double-edged sword.
people think just buying
Hmm.
cheap is value investing. So past growth is not. We
Hmm.
need to think about future growth. So growth is one reason. Second, it could be balance sheet. Why future growth? All this mess up happened,
Hmm.
mess their balance
Hmm.
sheet, mess their debt.
Hmm.
So debt could be so your balance sheet and cash flow. There are a lot of companies you'll find कि bull market आता है तो it becomes a five bagger, bear market आता है तो 80% down. Bull market आया five bagger, bear market 80%. These are
Point
companies
to
which
bagger.
don't have a cash
Hmm.
flow driven business model. They show rosy
Hmm.
P&Ls, and P&L is all accounting. P&L has nothing to do with real profit. You can show any revenue you want to show. So
Hmm.
cash flow and balance sheet capability. And fourth is your management reputation. Like there are a lot of companies, I don't want to talk in detail, but there are companies where 6 years back the CEO was arrested for some fraud, and that company is still there trying to change its image. But many times it takes years to change the image and market to get that confidence. Or many times in bull market it will run, but people know that this is not a stock which you should marry. So the moment bull market ends, they will dump that company. So these are some of the reasons. And the fifth reason is valuation itself. Like, everybody was gung ho on a lot of platform companies, and you have been tracking me, so you will know how much I was, hours against
I,
buying those companies. So even good companies, when you buy at obnoxious valuation, I saw somebody was mentioning Nazara Tech batao, Nazara Tech batao. Go and
हाँ,
check what is
हाँ,
the valuation of Nazara Tech. So when you
hmm,
buy things at obnoxious valuation, and Nazara Tech went, I
hmm,
think 3,000, 3,500 rupee. So then things start getting impacted. The next thing
hmm,
again, because somebody spoke about Nazara Tech, look at the promoter holding. People look for skin in the game to the promoter. If there is no skin in the game, why somebody will have a lot of interest to run the company and take the profitability
hmm,
to the next level and all of that. So you have to look at all these things. कुछ तो यहाँ numbers देख के आ जाते हैं, and for some of the things you have to go and dig deeper in the annual report. Like management quality, it's little difficult to just gauge. You need to go through the related party transactions. Ki, is management
hmm,
earning the money in decent way, or are they
hmm.
not siphoning off, but are they secretly trying to take some money out of the company
Business
in
and
their
into private into.
related party, sister concern companies, or maybe having their wives and
Hmm.
everybody on the board who are not contributing, earning. Like one company I remember, the wife was the CSR head, and the whole CSR spending was 30 lakh rupee, and the wife's salary was 45 lakh rupee. So how does it justify that salary? So you have to go through. So that is where you need to do all that detailed analysis, going through the annual reports and all.
Unfortunately, friends will refrain from taking names, but now I am myself curious. Ki CSR spending is 30 lakhs. The employee cost is 45 lakhs on the on same. In fact, you see related party transactions. So the seller is somebody, is the buyer of the product, or the seller of the product is somebody from the company only, supplier and the customer. So you don't know at what rates the transactions are happening internally. So these things, no, while there are no shortcuts to it, you will have to have a very strong following of promoters. You will have to. So in fact, to some extent, what I have found is many forums like Twitter, many forums like Value Picker have certainly helped my investment journey a lot, because many investors like Saurabh Bhai, there are various other marquee investors who candidly give their opinions over there. Okay, though this is a public platform and we will refrain, but do explore your companies, even your existing portfolio. Just go back and see what is the sentiment and what is the promoter quality like.
Yeah,
Uh,
so
yeah, Saurabh
Janak,
Bhai.
some framework also I have. If Like let's say you companies pass first the screener stage, next is pass the stage one where you individually analyze the numbers, then you do the comparative analysis, 3 stage done. Fourth stage you have to do a deep dive, you have to do in detail. So what you should do, so let me just share again one slide, it will highlight where you should put your efforts. And this is where you will be left with 50, 60 companies. So in a year, let's say if out of 50 you're studying 25 companies, or collaborate, make friends, like-minded people, distribute it, 3 friends, 20 companies, and then share your knowledge. That is how we do, like we maintain a close-minded group. But this is only for annual report, but in spirit, this is how you need to check any research report, any con call transcript, any investor presentation. First thing is, so I am focusing on annual report, but you can extend this concept to all the relevant documents of the company you can study. So first is the management communication letter, the MD writes, and I have seen different kinds of managements. There are managements who will talk only about when things go wrong, they will talk economy डूब गया, ये हो गया, वो हो गया, चाइना हो गया, ब्राजील हो गया, and when things go right, they will take all the credit. So it takes time and it comes with experience when you read 100, 200, 400 annual reports. But ideally, what you should look at, the communication should be crisp and clear, less of buzzwords of moat and all of that, more of execution things. The more company proves its execution capability in terms of number, the better it is. Look through 4-5 years of annual report. Did they make any promise that this is what they will do? Did they do or not? Have they improved or not? Are they talking in terms of numbers or not? Are they keeping it crisp, point to point, what they want to achieve and how they want to achieve? Are they doing or not? What is their vision? And then see if that is converting into business performance or not. The second important section is management discussion section, which gives all the detailed information about what is the business, how many subsegment, how the business is doing, how the industry is doing, what they aspire to do. So you get to learn a lot about the company business model, about the sector, about the opportunity, about the market size. Because remember, I told you about the growth thing. So how do you know growth? So market size. If the pond is smaller, how a single company will grow? But if the pond is bigger, even 5 companies can grow. Then depending. So all of that information you get from management discussion analysis. Business snapshot, again, you get all the breakups of the business, the risk, the opportunity, all of that. Director's report gives you a breakup of the financial, how the company has done. Don't worry much about this. I would suggest focus more on the related part. But yeah, look at the remuneration. Many times managements, they take obnoxious salaries. And this is a debatable topic. I have seen many companies who have really performed well, and 10% is the maximum limit of salary which management keeps taking. So if the management is performing and they're taking from pure salary, even though it looks high, don't mind. But if there are things like the company is not doing well, the revenue is going down, the profit is going down, and then management is taking salary hike, that is something which is bad. Or the management is taking salary through unwarranted means like related party transactions and all. So you have to see that. Then are auditors making any poor comments? So again, I will not name the company, but in this company, almost 40% of the revenue was coming in the form of cash. Now, if a company is earning 40% revenue in the form of cash, it's very difficult to establish the sanctity of the P&L and the balance sheet. So look for those
Correct.
kind of comments. And then your whole financial analysis. So screener pe to when you go, it's all five lines, but you have to go at a schedule level and understand. And I can tell you, many times lot of investing insights come. Many times you will realize there is one time expense which happened, and if you remove that one time expense, 10% ka APS growth will come only because of that. So there are a lot of small nuances you learn out of doing a detailed schedule level analysis. And then form and disclosure is for the subsidiaries. Why it is important, again I will tell you. Let's say there is one company, and this company has 5 different subsidiaries. One is the India business, one is Brazil business, one is US business. It might be possible that 3 subsidiaries are in loss, and the moment they break even, you will get a huge lift in profitability. Or 2 subsidiaries are new, they are taking time to break even. So many times we take very easy decisions on PE, that this is costly, this is cheap. Many times I have got a lot of insight based on that. Okay, this subsidiary looks like they're planning to turn it around, and once this turns around, there'll be a big profit jump which will come. So all of this helps. So this is where you should focus on and try to look from this angle and explore extract the information, read 3, 4, 5 years of annual reports, try to read it chronologically to understand what was promised, what happened. Is it and then you'll get a feel if it is a good management, if it is a performing management, if it is a honest management, and then accordingly you can take your investing decisions.
So very interesting points you made, Saurabh bhai. In fact, in middle of discussion, I had two queries. Okay, slightly specific, and some time back you made the point on promoter. Does promoter have skin in the game or no? Okay, how do you see that for a professionally driven company where there is no promoter?
So there are 2, 3 things. One, sometimes
Hmm.
it can happen because of regulation itself. Like if you take
Hmm.
banking, you will find even your HDFC and Kotak, the holdings is low. Simple reason because the regulator itself doesn't allow you to hold more than X percentage. So you can't do
Hmm.
that. So if
Hmm.
those are the
Hmm.
things, you can't do it. It's for everybody. But if it is a normal industry and the
Hmm.
holding is very low, you need to understand why the holding is very low. See, it could be
Hmm.
low. There are certain promoters who want to grow fast. And to grow fast, they might have gone for dilution as a route. Like Laurus Lab is one company, you will see the holding is 32%. But this company
Hmm.
started in 2005. And what many pharma
Hmm.
companies did in 50 years, this company did in 15 years. So this guy
Hmm.
wanted aggressive growth and he was ready to dilute and he went. So it's not always a low thing is bad, a high thing is good. You have to understand the reason. If the reason
Hmm.
is they're diluting and still the business is non-performing, that means it's a bad business. They keep need to
Hmm.
raise money in the form of equity and debt. So the thing is, if he has high stake 60, 70%, his dividend itself will be high, his market valuation will be high, his own net worth will increase. So that gives confidence. But if it is low, try to look at the reasons, and the reasons are genuine, like regulatory reasons, like reason of quick growth because it's a new company but he did, then it's okay. Professionally managed company, this concept is new to India, because if we see all the IPOs which have come before 2020, most of the IPOs were IPOs of not next gen companies where promoter had decent stake. It is
Hmm.
for the first time which is happening where this kind of scenario is happening. In US it is this practice is there, but then in US the corporate governance standards and the ability of normal investors to go and question proxy investors, that culture is much more evolved. In India that culture is not there. We'll see with time,
Hmm.
but you need to see what is in the skin in the game for the guy who is running the show. Is he getting
Hmm.
compensated adequately? But extreme of anything is
Hmm.
bad. Like today there is a news
Hmm.
going on that Paytm that Sharma, he is having 750 crores of ESOPs. So
Hmm.
is it like free ESOP but raha hai? Yeah? Is it like ESOP is there, but boss, you need to perform. And once you perform and
Hmm.
give a return to your shareholder, then only you can take that share back. So all that you will
Hmm.
get in annual report, and that is again why you need to read annual report and see is it like ki free mein ESOP but raha hai, or the management skin is there that look you perform and then you can convert your ESOPs. So when it is lower stake, you have to go in little bit of detail and take care of those things. When the stakes are high anyway, it's there.
Hmm. Got it. Got it. So I think that is it. So Saurabh bhai, can we take few Q&A if there are any? If there are
Sure.
none, any additional points, can we move on to Q&A? There are some
You check and
questions which
let me
really
know.
got me. Yeah. In fact, one question, Saurabh bhai, got me really interested. Okay, and that is, chalo, sab stock box sab mil gaya. We identified one of the best stocks. Even if we get conviction, how much weightage do you assign to a particular stock? Best stock of your kitty.
So see, this debate will never end. This
Hmm.
concentrated investing versus diversified investing. And
Hmm.
I mean, I have there is a book, there is a data of world's biggest top 50, 60
Hmm.
investors who managed
Hmm.
money for more than a decade. So anybody who has a
Hmm.
reputation for less than a decade, he has not been considered. So minimum 15 years of history, and those who have
Hmm.
generated more than 15, 20% of return in US. You will find all sorts of investor. You will find a concentrated investor, you will find a diversified investor, you will find a techno funda investor, you will find a quants guy, you will find a normal discretionary investor. It is the process how you are mastering it, and are you comfortable with that process intellectually and behaviorally. सो सुन लिया कि
Hmm.
कॉन्सेंट्रेटेड इन्वेस्टिंग अच्छा है, 20% ले लिया और रात को 2 बजे उठ के प्राइस देख रहे हैं कि यूएस का मार्केट क्या कर रहा है, दैट वोंट हेल्प. So you
Ah.
have to be comfortable with that process, whether you are owning 2% or you are owning 10%. It's the process, and there are 20 different ways of making money. Because how are you allocating? Whether you are buying in one go or you are somebody who keeps
Hmm.
buying slowly. Are
Hmm.
you somebody who has having a lump sum money, or are you somebody who is having a monthly salary? Are you somebody who gets panicked in the market, or are you somebody who has a lot of mental patience? So
Hmm.
everybody is different and there is no right answer. You have to first find who you are and what gives you comfort, and then what is your goal, whether you want to achieve 15% or 25%. And then sometimes there could be sectors where you don't have expertise, like a sector like a bank. Big investors, they can't, because company ka CEO doesn't know what kind of fraud will happen. Or pharma sector, which is very uncertain, CEO doesn't know out of 100 molecule which molecule will become successful and blockbuster. So this sectors which are very complicated, where it's very difficult to build that expertise. So you might take a high stake in one sector, but maybe you may not allocate more than 2% in another sector. So think from all those angles and then take a call, rather than getting into this debate of good or bad. What I do, I will tell you, is, so beyond all of this, I have a scoring methodology. So as I said, these 4 parameters are there. I take few more parameters and I try to rate a score. It's not like a rule I will follow, but this helps me. If a stock is getting,
Hmm.
let's say, only 55 score and I want to allocate 10%, there is a question on me: why are you allocating 10%? The score is not good. So either you have not scored properly, you have missed something, or maybe you are getting over biased in your emotion. So I try to keep it somewhere but between 2 to 6%, depending on my expertise, depending on how cheap it is, how attractive is the valuation, lot of other factors. So my suggestion would be, if you are new to the market, don't go beyond 5%. If you have spent 4 5 years in the market, you have generated decent return irrespective of market cycle, not because of luck, then try to go beyond
Hmm.
5% as you get more and more confidence.
Great. Very well put. Very well put. Depends basically on what mindset and what journey you are in yourself. So, Saurabh, you want to take any question from the chat that hits your mind? I'll leave that to you. If you find any
Okay,
interesting
let me go.
stuff.
Uh, so it is done. See, ROE, ROCE, E is equity, return on equity, return on capital employed. So when you take equity, you are considering what return equity holders are getting. But when you see return on capital employed, it's the whole capital deployed, which is both equity plus debt. So companies can show, sometimes good ROE because they could have grown by leverage. Whereas, so I find ROCE is a much better metric than ROE. But in banking business, it's ROE because it's a leverage business. So in banking, you can look at ROE. Sales, operating margin. So no one number is sacrosanct. See, if decisions could have been taken just on one metric, then everybody would have become a billionaire. So that is why
थोड़ा
I have a
automated हो
screen of
जाता.
70 80.
Hmm.
Yeah, so
Hmm.
70 80 parameters. So once you start looking
Hmm.
at it, every industry is different. I can't say there are certain industries operating margin is not that important. There are certain industries where it could be very important. So all these financial parameter also you will have to understand by industry. Like a retail industry, if you are not churning your shop floor, you are gone. In retail, all your perishable product, they will become useless. So in retail, inventory days becomes the most important metric. So you will have to analyze industry by industry and learn which metric is important for which kind of industry. But ideally you should look for companies which are good on all the aspects. Okay. Stocks, I don't want to talk much.
Hmm. Yeah, yeah, we
So
can
see,
skip
some
that.
companies, even zero promoter is okay. I mean, you need to check many times. Like if you see ITC ideally has promoter, but if you see Government of India can't be a promoter as such. Then you have a tobacco company who is more a shareholder. So sometimes there could be situations where these things are possible. Like L&T is a company with zero promoter, but it's a professionally well-run organization. So as I said, low promoter holding is not like 100% no, but you need to understand why it is low. And like I told you, some of the reasons why you should look at, like maybe a dilution which has resulted in business value creation. So you need to go and study why it has happened. Criteria for exiting a stock, 4 5 things. One, if the stock, what is your investment philosophy? Are you a two-month investor? Are you a 2-year investor? Are you a 10-year investor? So
Hmm.
depending on that, you need to see what is overvaluation for me. The way I do it, I see, can this stock fall 50%? Is it so overvalued? If it is yes, then I would like to book some profit. I am a admirer of technical analysis because fundamentals baad mein aata hai. People see, we are not the supplier of the company, we are not the customer of the company. Those guys, they will always have first hand information. Retail will always know in the end when the whole chapter is over, and that is why you see ki game first happens on the chart and then you come to know in the results. So that is why I am an
Hmm.
admirer of charts. If I see a lot of weakness in chart, if my valuation is telling it's super overvalued, I would like to exit. Or if you find a better company and you don't have cash, that means you need to sell something. Or if some stock becomes more than, let's say, 15-20% of your portfolio, it has grown so much, you are not comfortable, the valuation is also high, you can sell it off. Or your whole thesis has gone wrong, like I invested in one company and the whole management got changed. So then there is a whole new management, I don't know how they are going to do. So these are some of the 5-6 situations when you should think of selling a stock. Yes, the auto sector, steel will not, the whole auto sector is cyclic sector. So you need to time the entry, you need to time the exit, and that is why investing is not so easy. So you need to pick it. So that is there. Specific to this company, this year the export will also not be good. There will be a 35% reduction in the export. So finding the risk is more important than finding the opportunities.
Very valid point. So see, he has been studying this company, so he knows the immediate future, what is the export going to look like, and this is the edge that you will have when you study the company in such a depth. Great, Saurabh.
And
Yeah,
I might be
please.
playing the whole auto sector as a basket approach. So my approach could be very different. I might be playing a momentum. The moment I see the charts is getting weaker, I might exit. So there are a lot of other things. Okay, re-rating in IT is already re-rated, boss. Just look at what is the 10-year PE of IT. So
Hmm.
I remember in 2016-17 when all these companies like Persistent, Tata Elxsi, they were available at 14 PE, nobody wanted to buy it because the story was automation is coming and you don't need Indian engineers. So nobody was willing to pay 12, 15 P. And now people are willing to pay 100 times earning because digital is there. So I believe IT was all, again, if you go through my tweets again from October, I did shout on IT also. The correction did happen. I think, I don't know if IT has bottomed, but I think the downward trend is over. It might go under a consolidation phase, or if the IT industry keeps doing well irrespective of, see, it is one of the most, it is one of the cleanest industry where you get a industry where so much of wealth has been created, so much of professionalism is there. वो लाला वाला culture नहीं है. It's a very professionally run industry, so much of dividend is shared. It is one of the better industries, and I think it did deserve more than a 15 kind of mean P, which is there. But frankly, I am bullish on some other sectors rather than being in IT, because I think sectors where a lot of wealth is created recently, those sectors don't run again, with that kind of intensity. If you see the biggest seller in IT were FIIs, and the DIIs, they had two sectors to buy. So this whole 1 year FII selling which has happened, which is known as the biggest
Hmm.
selling in last 80 years of history, it happened in two sectors: banking, IT. 50% of the FII selling happened in banking, 20% of FII selling happened in IT. Still, the banking index corrected only by 10%, the IT index corrected by 30%. Why? Because the buyer DII didn't find IT attractive. It is the retail which is finding it super attractive and buying every dip. So
Hmm.
I am not very bullish, but I think the bottom has been met. And maybe for a SIP perspective, for somebody who is a long-term investor, a SIP is a good idea in IT. But beyond that, not no further views. I
So
think
the
we
whole
discussed.
point, whole takeaway seems to be here is that you might not get abnormal returns of 2021. Okay, at best maybe market returns are slightly below it. This is in a way something that I make get sense. Yes, Saurabh, you are moving ahead.
One person has been asking logistics sector multiple times. So see, I don't have a lot of deep knowledge on logistics, but one thing I can tell you, logistic itself is a very distributed kind of business in sub segments. Like you can have a port logistic business, you can have a road related logistic, you can have this B2B industry
Hmm.
logistic. So different sub segments, and all of that get driven by different things. Like your rail logistics is very different, your port logistic is very different. So if India is a country where there is a lot of leakages in logistic, and those leakages can give very good opportunity, but it needs very detailed study, because if tomorrow this whole dedicated freight corridor and all they come, they have ability to reduce the growth on the road transport. So I'm not telling this will happen, that will happen. I'm telling all these possibilities are there. So you will have to look at those deeper angles. I don't want to give any generic view and misguide by telling, but
Correct.
this is what is required. Second, logistic is a very, very low margin business. In a very low margin
Hmm.
business, not everybody will succeed. Few who are able to
Hmm.
build that economies of scale, they are the one who will be able to succeed. So look at these kind of companies. I think TCI Expresses, that is one company. I'm not invested right now, but I like that company again because of all these parameters. History, the company became again overvalued. No, so say it went to 2500, corrected now at 1700. But I find, look for those kind of characteristics in a business. Valuation is a separate topic.
So one good question, Saurabh bhai, I got here, and I really want, so I want to extend the question. Okay, while so somebody has asked. So Saurabh bhai, hypothetical question to you: the day you turn 45, how would you look at your portfolio management? A typical 80-70% year old, we can assume certain things here. A 45-year-old who has kids who are in mid school, has to plan for higher education, who has wife and certain dependents, and who has to plan for his retirement also. How would you see portfolio management in equity at this time of your life?
So there was one question for 45-year-old, but is your question exactly same, or is it like at different ages?
Exactly
How?
same. Yes, my question
Okay.
was extended version of this. How do you see at this
So
question?
see this portfolio, no, it's like it's not the end game. See, the purpose of life, think, that is how I think is, the purpose of life is not to make 40% return. The purpose of life is maybe to live, to own a house, maybe to own a car, to maybe to get daughter married, son married, education, live a happy life post retirement. Start from there. Financial planning, start from there. And everybody has different kind of income, and everybody has different kind of investing lifestyle. See what is the lifestyle, what are your aspirations, and for that what is the money which is required at different point of time in life. Somebody might be happy even with a 12% return, because whatever he wants to achieve, that is possible even with a 12% return. And for somebody might needs to generate 20% return. So first do all this analysis. And equity is just one asset class. You have debt, you have fixed deposit, you have gold, you have real estate, all these things. So think from first financial planning angle and see how much of return you need to generate to achieve all the financial goals of life. And then to generate that return, how much you need to allocate. And then comes कि कितना portfolio होना चाहिए in equity. Now at this stage, so the game is simple. See, equity is a thing which is very volatile. Whenever you are putting a money, not trading, investing, because trading there is a stop loss. In investing, if you don't follow stop loss strategy, you are a long term investor. Always be
Hmm.
ready to face a 20% drawdown for 2-3 years. 2011 to
Hmm.
14 it has happened, 8 9 it has happened. Small cap investor 2018 to 20 they have seen.
18.
So put only
Hmm.
that money which you don't need to look for next 3-4 years. And then see at the age
Hmm.
of 45 what is the percentage of allocation you are comfortable. Second, as you progress in your age, anyway you will keep achieving your financial goals. So जब लाइफ का ऑब्जेक्टिव पूरा हो रहा है, तो फिर आर यू इन द मार्केट बिकॉज ऑफ पैशन, और आर यू इन द मार्केट बिकॉज ऑफ दैट. सो RJ sir, even till he left he was there in equity because he loved it. So
Hmm.
if that is the case, it's a different thing. You don't need anybody's advice. But if it is more from a financial planning angle, like you are invested in mutual funds, of course, as you grow in your age, as you retire, reduce the equity, and the more younger you are, have a higher allocation. I believe till 50 we can still have 50-50. After 50, focus should be to reduce equity. Until you understand the game and you have this money with at least a 5-year view, you don't need that money. So that is how I would put it. At 45, maybe 60-65%. At best, when the markets are very attractive. When the markets are not attractive, very overvalued, I would suggest, I am a believer of profit booking. So when markets are overvalued, I like to take back cash. So accordingly, you can take a call.
So I like to add here. See, while Saurabh has committed certain ballpark numbers, do not shy away from consulting a financial advisor. what I have realized is we are not happy to consult finance. अरे बात तो करो एक बार, पूछ के तो देखो, वो नहीं चार्ज कर देगा. At least spend 10-15 minutes with him. Trust me, 1,000, 2,000, whatever he charges, that conversation of 15 minutes which you will have with a certified financial advisor will be in worth gold. That will open your eyes to many avenues. Do it. Do not just take it as a number because it is coming from somebody. Take the thought process. Yes, Saurabh bhai. So we have 5 minutes, and while I आपने आरजे सर की बात बोली, उस पर मुझे ऐड करना था कुछ. Till the last day, in fact 3-4 days ago, he was talking about how bullish he is on India, and that emotion matlab gives so much of conviction that Indian markets, boss, are the place to be. Okay, you see the GDP data, you see the IIP data, the world over, पूरी दुनिया में आग लगी हुई है, यूरोप, चाइना, एशिया, sorry, Americas, but India is somehow shielded, the domestic economy, and really loved RJ sir for that, the conviction on India as a theme. So yeah, chalo, but his learnings will always stay with us. He will be dearly missed, the optimism and the insights. Yes, Saurabh. So we still have 5 minutes. I leave at your discretion. Basis your understanding, you can pick a couple of questions, and maybe
I
then we can
think
wrap up.
there is one question on future sectors, and there is one question I see on chemical. Sugar, again, if it is too complicated, don't get into it. See, any sector where 80% of wealth can get distracted until
Hmm.
you have experienced 2-3 cycles in the market, be cautious. Chemical sector, I think a lot of froth was there. It is getting clear. A lot of companies have corrected. I think their margins are again at a lifetime low margin. These margins are not like, it will stay, it will turn to upward, but that may not happen in 6 months, 1 year. And again, you will have to check the data. Like I'll tell you, I was reading annual report of one company called Sudarshan Chemical, was going through the conference called transcripts. The numbers are at the worst, and that is why the valuation is also lower than the mean. And thing is, in Europe things are not good, and this company is exporting in Europe, and first the demand ki what lagi hui hai, and then there's a oversupply. So things are slowly coming back to chemical again in parts. See, certain stocks are still in big euphoria, certain stocks are cheap, but the sentiment is not good. So it's a good sector, but again, it's also a cyclic sector, and there are businesses. The best way to identify is first look at the gross margin. Everybody will tell, like this Jubilant in Gravia, all came via specialty chemical companies. Specialty chemical companies don't lose 50% margin in 1 year. So look at the gross margin. Ideally, a high margin companies, in chemical, they will be specialty chemical. Look at 10 years of history. Are their margins constant? If it is a constant, then there is really something special in that company. I made a video sometime back on ultramarine. Look at the last 8 years of margins of ultramarine. So you will have to find which is a commodity chemical and which is a chemical with some pricing power and analyze. Else, it's a decent sector if played well. Future sectors, I believe. Uh, One in auto EV is good, but one warning: anything which is very hot in first wave, everybody makes money, but a lot of frothy companies come. They will just do an announcement
Hmm.
and then prices will go up. And then when the wave will get over, 80% of the companies will vanish. That is what happened in IT boom also in 2000. So it's a
Hmm.
call whether you want to play in the first cycle or second cycle. But some of the themes I see is renewable is a theme. Insurance is a very decent sector with very good 15% kind of runway. Then IT is still, I feel IT is a decent sector to play, at least 10% plus kind of growth rate. Then in healthcare, there are a few sectors which are growing well, but you need to identify companies like CDMO is a decent play. Healthcare, medicine, pharmacy is a decent play. On my YouTube channel, I made a video regarding top 10 growing sector. So some of the sectors which came on my mind, I spoke about. But yeah, you can look at renewable sector. You can look at things like the recyclable as a theme, or in automation you can look as
Correct.
a theme. Shared economy you can look as a theme. Electrification and the automation of certain sectors you can look at as a theme. So these are some of the themes you can look at.
So Masoom ji, let me add to the thought process of Saurabh bhai here. Okay, he has given us a very good insight that, see, the needs are not going anywhere. The transportation need is not going anywhere. Just have a look how it is evolving. Okay, maybe the IC engines are in a phase where they will subside or they will go into the sunset. Maybe the electrification is coming. Okay, maybe that the normal tech will be still there, but there is some specialized tech. Okay, engineering resource and development, research and development. So look at how the way the whole need solving is getting changed. Okay, the need will always be there. भूख लगेगी ही, ट्रैवल सबको करना पड़ेगा ही, हेल्थ केयर भी सबको जरूरत पड़ेगी ही. But are there any different biosimilars coming into play? Look at that and then start analyzing, because the companies will be disrupted all the time. Okay, you never know. Today, if Saurabh bhai says electrification is the theme, but you never know which company is getting disrupted. Okay, not getting into any names, but very good, Saurabh bhai. I really loved the thought process. See the way that need is getting addressed. Is there a fundamental change to it? Yes, Saurabh bhai. So I think it is, yeah, you want to take any questions? I think we are done more or less. Thank you,
We are
Manohar ji.
done.
Most welcome.
Very well highlighted the crux of the message. So thanks, Janak.
Yes. So with that, we'll wrap up. So, but before that, Saurabh bhai, really 1 hour flew by in the discussion, and it didn't feel like we should stop right now. I don't know, but really, this was one of the sessions which I personally thoroughly enjoyed, and with the amount of engagement that I saw, really loved it. So, would like to thank audience on behalf of Saurabh bhai, and more importantly, Saurabh bhai, thank you for coming out and sharing your valuable insights. We will take this away with us, and now back to the drawing board. We'll re-look at our portfolio with a very different lens. So thank you for Saurabh by
Thanks.
coming.
Thanks a lot, Janak, for inviting and for everybody. So Janak and I, we belong to same college. We did our MBA from same college, so that is the common bonding. And I would have loved to take more questions, but it's a weekend. I have guests at my place, and I've told them that I'll be available after 8:30. Else, I would have loved to take more questions, but maybe some other time. So thanks again for inviting.
So slight make allow me to make a slight correction. Saurabh is 2 years senior to me, both, and manifold senior in investing also. Okay, and I am honored to be called to belong to the same institute as Saurabh, and maybe taking his part towards learning. Yes, Saurabh. So just that, nothing else. So thank you for coming. I'll close the session, I guess.
Thanks, Janak. Thanks everyone.